All right, so I think we can start. So good morning, good evening, good afternoon to everyone, wherever you're sitting. As I said, we are very excited to host this launch session of blended finance for PPPs. It's a very timely session, and we are also excited to have all our partners here together and host this session and organize the sessions going forward in this year. So I think the first thing I would like to do is hand it to our president, Ziad Alexander Hayek, for opening remarks.
Thank you, Jyoti. Hello, everyone. It's my honor to welcome you to our event, the event launch on mobilizing blended finance for PPPs. For 2025, WAPPP is proud to dedicate its efforts to the theme of blended finance in public-private partnerships. This theme reflects our commitment to fostering collaboration between public, private, and philanthropic sectors to address global challenges and achieve the Sustainable Development Goals. PPP was expected to play an important role in attracting private sector investment to achieve the SDGs. This aspiration has not yet been realized. Too few PPP projects are being done. This is why we dedicated our efforts last year to exploring small-scale PPPs, and this is why we are focusing on blended finance this year. WAPPP is focused on developing thought leadership on blended finance to support the achievement of SDGs by creating more inclusive and sustainable PPP projects. This year, we will partner with key stakeholders to drive these goals through joint initiatives, including webinars, policy briefs, surveys, articles, and reports. Our webinars will serve as educational and collaborative platforms to engage stakeholders in the growing field of blended finance. We will also develop policy briefs with partners, offering clear recommendations on how to integrate blended finance into national and regional strategies. Additionally, we will conduct surveys with industry leaders to understand barriers and opportunities in blended finance, aiming to guide better decision-making in PPPs. Finally, we will publish in-depth reports and articles focusing on case studies and successful examples of blended finance to share knowledge with a broader audience. I'm delighted that we are joined today with our partners here. I will start first by introducing John Larea. John is CEO of Convergence Blended Finance, our partner during this whole year. Joan is a leader in blended finance with nearly 30 years of experience in emerging markets investing. As CEO of Convergence, she has helped establish Convergence as the foremost authority on blended finance, leveraging her expertise from roles at OPEC, Global Environmental Fund, and the International Finance Corporation. She also serves on several global advisory boards and investment committees focused on sustainable development and impact investing. Joan, it is amazing and a privilege and an honor to have you with us. I will turn the floor over to you.
Thank you. Thank you very much, both Jyoti and Ziad, for the really kind introduction. To introduce Convergence briefly, we are the global network for blended finance. And we exist to increase private investment in emerging markets and developing economies to advance the UN Sustainable Development Goals and the Paris Agreement via the use of blended finance. And we do that through four primary channels: education, guidance to the field, the forging of connections between practitioners, and by accelerating deal flow. And we are really excited to see WAPPP take on the subject of blended finance for its focus for this year. We're also equally pleased to be your partner on this journey. Blended finance is at its base, it's a partnership between, on the one hand, philanthropic or public partners acting concessionally for the purpose of drawing in private capital, and on the other hand, private sector investors and operators. As my colleagues will talk through later on in today's presentation, or in today's program, we see all shapes and forms of blended finance, but PPPs deserve to be their own area of inquiry because they are a long-tested form of structuring for those kinds of partnerships between public actors and the private sector investors of the world. So today, my colleagues are going to present on two subjects. The first is a primer on blended finance itself, with a particular focus on your world of PPPs. And the second is an introduction to a major initiative Convergence is undertaking, and which we believe forms an excellent basis for some concrete work between the World Association of PPPs and Convergence. Let me hand it back over to Jyoti.
Thank you so much, Ziad and Joan. Everybody can see the poll on their screens. So a really thoughtful opening and strong statements from both of our organization heads. At the same time, we want to also get to know you. So if you can take the poll so that we can see where everybody is joining, and so we can understand how we can apply these structuring approaches, how we can actually address your needs, and going forward, how we can structure our webinars better. So we can see that audience is joining from Africa, from Europe, from North America, from Asia. Well, good evening, everyone. That's amazing. And Latin America. So it's really great. So I want to introduce now the Convergence team who's with us. Joining us today for presenting Blended Finance Fundamental is Convergence, represented by Chris Clubb. He's the managing director. Chris has over 20 years of experience financing development projects in emerging markets. He previously worked at the EBRD and EIB. From Convergence, we will also have presentations by Mira Minkara and Nick Zelensuk. Mira works at the training and engagement team, and prior to Convergence, she worked at the United Nations. Nick is a member of the thought leadership team at Convergence and previously worked at UNICEF on the public finance team. As your moderator, I'm eager to facilitate an engaging and constructive dialogue that inspires actionable solutions and drives positive change. Together, we can explore how to overcome the obstacles and unlock the full potential of blended finance to drive sustainable development. So our next poll is going to be open soon, and please take that as we move to the presentation. I encourage you to actively participate in today's session, sharing your perspectives in the chat, ideas, questions. Your contributions are extremely valuable to us, and we work towards shaping a better and brighter future through collaborative action. So I will hand it over to, I think, Mira and Chris and Nick.
Thank you, Jyoti, and hi, everyone. Nice to meet you. My name is Mira Minkara. There's a bit of technical error, so you might see my name not represented, but my name is Mira. Nice to meet you. I work, as Jyoti mentioned, as an associate at Convergence. And today we are going to, together with my colleagues Nick and Chris, we are going to be walking you through the Blended Finance 101, or the basics of blended finance. So before we start, I just want to have a quick poll. Maybe we can start with just to get some interactions with what is the definition according to you of blended finance. So we're going to start a quick poll, and it would be great if you can answer that. So A, do you think it's an approach to investing, like impact investing? Or B, do you think it's an approach to structuring transactions, bringing in public and private investors? Or C, do you think it's an approach to contracting, like PPP? So we'll take maybe a few seconds just to get some answers rolling in. So maybe, Caroline, we can show the answers. Great. So you can't see the results, but I can see that more than around 80% of you have answered correctly. The correct answer is B. So indeed, blended finance is a structuring approach. It's not a PPP and it's not an investing approach. Many people might confuse it with the other two, but it is actually a structuring approach that brings in public and private transactions. So now that we have achieved the basics, let's dig a bit deeper into what is blended finance. So blended finance is actually the use of catalytic capital. Catalytic capital means concessional capital that is coming from a public or philanthropic sources, and that can be a foundation, it can be a public development agency. that is to increase private sector investment in developing countries with the overall aim is to achieve global development impact. So to make things a bit visual, if you look on the right-hand side of the slide, you see in the gray circle here, development funding. This is the concessional capital that goes into a blended finance structure with the aim to mobilize private capital that comes into the blended finance transaction at a market rate return. So this is where you see it's actually a structuring approach that allows different actors, whether they are impact-oriented or not, whatever their goal is, to basically to come into a transaction alongside each other and invest, and each will achieve their objectives, whether it is pure financial, what is pure social, or a blend of both. So maybe looking at also now the key markings of what would present a good blended finance practice. So it is represented by 3 key features. They are not in a specific order. 1 is return, 2 is impact, and 3 is leverage. Return meaning that the overall transaction needs to be making market rate return for private investors in line with the market, basically. So someone in the transaction needs to be making market rate return for this to be considered blended. 2, impact. By nature of blended finance transaction, as Joan has mentioned, the overall objective and activity is contributing towards an SDG in a developing country. And 3, leverage, meaning that the concessional capital providers or the public and philanthropic parties usually are leveraging their concessional capital to make a deal happen that would otherwise not happen. Otherwise, private capital would not go into that deal. So when we look at our database, according to our historical deals database, which we host at Convergence on blended finance, our data shows that for each $1 of concessional capital deployed to a blended finance transaction, it has mobilized on average $4 in commercially priced capital, and that is US dollar. If we want to look at what are the sources of blended finance, you might wonder who are the actors and who is providing capital to a blended finance transaction or a structure. So there are 3 main sources of capital. 1, as we have mentioned, the public investors, and they are represented by development agencies such as, for example, Swedish SIDA, by development finance institution, for example, FinDev or Finance Development Canada, or Multilateral Development Bank, which many of you might be familiar with, for example, EBRD. In general, we see that public investors invest in projects or facilities by deploying this capital to catalyze additional investment, and the average investment size, usually we see, according to our database, runs between 10 to 20 million US dollar. The second source of capital is actually private investors, and in private investors, we can divide them into 2 categories. 1 with strong impact mandate, for example, just pure impact investors such as Kenyarth, or active private investors who have without a broad impact mandate, for example, just commercial banks such as Societe Generale or Citibank. We also see them active in blended finance. In general, their average investment ticket size runs between 2 to 20 million US dollar. However, we do see that commercial banks sit on the higher end. The third and final actors or sources of blended finance are philanthropic investors, and they are represented by foundations you all might be familiar with, such as the Shell Foundation, the Gates Foundation, etc. We usually see that type of capital more as grants, as recoverable grants, and very much concessional and catalytic by nature. Their investment sizes also tends to be on the smaller size of approximately 5 million US dollar. Now, when we look at what is the overall objective and goal of blended finance, it's actually to create a risk-return profile that is acceptable for a private sector investment to go into an SDG in a developing country. If we look at how that can be achieved visually, we can look at this figure here and we see that a project, for example, without blending or before blending might be sitting here, which is outside the fiduciary acceptable risk for basically for a private sector investment. This risk is too high in comparison to the return. So what blended finance can do, it can intervene at two levels. One, it can intervene by de-risking the project, moving from point A to B, or by enhancing the returns, moving from point A to C. For that expected level of risk, increasing the expected return. So this is where we see blended finance coming in, basically to make it more commercially acceptable for a typical private investor to come into a transaction. We also see blending happening at different levels. We can see it happening at a project level. For example, we can see it happening within a single project. We can also see it happening at a fund level where private and public different investors pool in their resources and deploy it across different projects. We can see it happening at a facility, a company, or even a bond level. So really, it can happen at multiple different stages. If we look at an example of a life project cycle, one of the main critiques might be that, oh, blended finance, this limited concessional capital is maybe subsidizing the private sector. But in this example, we want to ensure that actually the approach of blended finance is to minimize concessionality and maximize additionality. We don't want to subsidize the private sector. It is deployed according to where it is at a specific stage in order to reach commercial viability. So think of an example of a hospital. For example, if you want to build a specific hospital or a clinic in an emerging market, at first you have a lot of expenses to go for where our feasibility study, technical, construction, etc. So this is where more and more concessional capital we see in the preparation, in the formation and construction stage, which are usually earlier. And as you move forward in the project life cycle, the concessional capital becomes less and less, and commercial capital is replaced. So that is one key feature we wanted to highlight here, that actually blended finance is tailored for each stage, and we want to ensure minimum concessionality at each stage. And finally, I will wrap up my part to just explain the differences, because this is a PPP crowd, between a PPP and a blended finance. So just overall, the main, for example, objective of a PPP is to execute a contract for a specific public service, where for blended finance, it's a structuring approach, as we have seen. The main stakeholders in a PPP can be public and private, but in blended finance, we see also philanthropic actors in addition. PPPs usually are contracts, where blended finance, as we have seen, they can be fund, a facility, a bond, or a project. Also, PPPs target mostly infrastructure, where blended finance target, it's sector agnostic. We do see more investments and more projects in energy and in financial services, but it's more sector agnostic. In a PPP, the risk is borne usually by a private sector. However, in blended finance, it's by public and philanthropic sector. And an indicator to a success for a PPP is the efficient project management delivery, where for a blended finance, it depends on the investor. If you're a market rate investor, your return on investment. If you're an impact investor, it might be other impact objectives, KPIs that have been identified. And with that, I will hand over to my colleague, Nick, who is going to be walking through the second part of data with you. Nick, over to you.
Thank you. Yes, thank you, Mira. Hello, everyone. Again, my name is Nick Salenchuk. I am on Convergence's content or thought leadership team. So as Mira mentioned, I will briefly be highlighting some key trends and a couple of case studies in the PPP space from Convergence's historical deals database, or what we call the HDD for short, which is the industry leading repository of blended finance transaction data. So just before we get into some of the details on the data, our database captures deal level information across various parameters, including impact data, investment level information, and structuring approaches. So while we don't currently identify or disaggregate blended finance transactions on a PPP basis, we can give some proxy information into the financial vehicles, deal sizes, blending tools, and investment methods on the types of transactions that could combine PPP structuring and blended finance usage. So to note, the following information, which I'll present over the next couple slides, encompasses the common sectors, specifically energy and non-energy infrastructure, and the deal types which overlap with PPP deals and can be indicative of blended finance and PPP use. So Mary can go to the next slide. So here we have broken down into two key overarching sectors relevant to PPPs, into the types of financial vehicles of blended deals. So I want to direct everyone's attention to the project and fund transactions highlighted within that red box there, given that they are the most relevant for the PPP model. So we can see these two categories as representing portfolio level approaches, so that's on the fund side, and project level approaches to funding infrastructure. On the portfolio level, private capital is mobilized into a fund structure using blended finance, which then those funds invest on a commercial basis in single or multiple projects downstream. And then on a project by project basis, we see various structures, including project finance and corporate finance. So through both channels, we do see the use of SPVs or special purpose vehicles at the project level, which can be preferential for private investors because of the greater ability to control project cash flows versus investing through infrastructure corporations, for example, that might manage multiple projects on the ground. So going forward, we'll be focusing on these two transaction structures going forward. So non-energy infrastructure sees greater variability in size, so in deal size, with a greater concentration above $250 million versus energy deals, which tend to be between $100 million and $250 million. If we compare these figures to those of infrastructure funds, we see that funds tend to be noticeably smaller on average. However, funds do offer exposure to large projects downstream and provide key diversification benefits, including by sector and geography. So this makes them attractive from a risk-adjusted return perspective to investors seeking maybe new exposure to the asset class, new exposure to a geography, and potentially those searching for higher yields. So as Chris will go over later, we do see significant scaled standardization potential for blended funds targeting these assets. And lastly, on funds, intermediaries, financial intermediaries like these are important for investors who don't have the internal capacity or the resources to maybe invest directly into infrastructure projects, given some of the legal, technical, or industry complexities. Next slide, Mara. Thank you. So moving on to the most frequent blending archetypes or blending models that I believe Mira mentioned earlier, the use of concessional debt or below market rate debt and equity is most common, and that is then followed by concessional guarantees. So concessional debt and equity can be used to backstop losses in a downside scenario, so in a loss scenario, and also reduce capital costs for the borrower to enhance potentially the credit standing of the borrower. Whereas guarantees can be particularly important at the project level because they can be tailored to cover specific risks. For example, off-taker risk from national energy utilities. Next slide, Mira. So looking to the primary subsectors, so within that energy and non-energy overarching sectors, we observe blended finance to mainly be oriented towards the development of renewable energy assets and improved energy efficiency on a utility scale. So while less frequent, non-energy infrastructure deals, specifically water infrastructure and transportation, actually do comprise typically the largest deals that we see in this space. Whereas social infrastructure, including health-related infrastructure like hospitals, or more infrequently leverage blended finance. So this could be a combination of lesser engagement from the private sector in emerging markets in these two, so in the social sectors, so in health or education, especially from international or cross-border investors. Next slide, Mira. And finally, here we look to some of the overall investor trends in blended finance and PPPs. So the chart on the left, we see the breakdown by investor type by share of overall financial commitments into these deals. So by total number of actual investments by investors. So DFIs and MDBs, or development finance institutions and multilateral development banks, and commercial investors are the primary providers of market rate capital to deals in this space. And then if we look to the right-hand side, so the concessional capital chart, so again, that's referring to the below market money that is being used to mobilize the commercial or market rate investment. We see that development agencies are the majority providers of concessional capital to both projects and funds. So among this group, key players include multi-donor capital pools that are administered by the DFIs and MDBs. So that could include the Canadian Climate Fund for the private sector in the Americas that the World Bank manages, as well as multi-donor organizations. So for example, the Private Infrastructure Development Group or the Green Climate Fund. So we do find that an essential barrier to greater implementation of blended finance PPP structures can be the inadequate PPP regimes in emerging markets. And that's specifically from the perspective of international or cross-border investors. So laws within these markets can insufficiently address key considerations that these investors are looking at, like foreign exchange guarantees, step-in rights, or revenue sharing mechanisms. So here we actually do see a lot of importance in upstream activities or initiatives, such as technical assistance, which can help better align those legal components with those investor requirements. And next slide, Mara. So moving on to our two case studies. So our first example looks at the Kigali bulk water supply project. So Kigali Water Limited was building Sub-Saharan Africa's first water supply project using a PPP model in order to attract private sector investment into their project. So KWL, or Kigali Water Limited, which is a subsidiary of global utility company Matito, entered into a 27-year build, operate, transfer, or bought agreement to sell drinkable water to the public utility in Kigali. Debt financing for the project was provided by the Emerging Africa Infrastructure Fund, which is now known as the Emerging Africa and Asia Infrastructure Fund, alongside the African Development Bank. And interesting here was two other PIDGE companies, or the Private Infrastructure Development Group companies, to which EAAIF belongs to, were also involved. So the first was DevCo, which provided a grant for the legal, financial, technical, environmental, and other feasibility study needs, while the PIDGE, or Private Infrastructure Development Group, also provided technical assistance through their technical assistance facility, which provided viability gap funding to reduce upfront costs and really be able to bring in those private sector investors and cover the timing gap between securing that capital. And next slide, please, Mara. And to our second case study example, we look at a waste-to-energy power plant in Serbia. So this project set out to develop a waste-to-energy facility at the time, Europe's largest unmanned dump site, which was in the Vinča suburb of Belgrade, Serbia. So the International Finance Corporation, or IFC, engaged in the project at actually a very early development phase, when it was approached by the city of Belgrade to help design a PPP structure to execute the project. So at the time, the city of Belgrade did not have a formalized PPP regime, which was they found to be really limiting their ability to execute this project and bring in cross-border investment. So the IFC provided upstream technical assistance funded through blended finance from the government of Canada through one of those donor capital pools to then transform that regulatory architecture for infrastructure PPPs in the city of Belgrade and improve the efficiency of public sector management of these large projects. So not just this project, but all those going forward. However, additional market construction, country, and other investment risks still required further blended finance instruments, so further de-risking or risk mitigation. So the IFC, along with the project sponsors, secured concessional capital from other World Bank capital pools, also funded by the Government of Canada. They also secured concessional money from a development fund from the Government of Taiwan to actually reduce the burden of cost recovery through the city's waste payments, which would then provided the ability or unlocked the ability to mobilize debt financing from a series of multilateral development banks, which did include EBRD, as well as other commercial investors, mainly from commercial banks. So I will now pass it over to my colleague, Chris Clubb, who will introduce and highlight some of our work on a core project that we're looking at on standardization in blended finance. Over to you, Chris.
Thank you very much, Nick. Next slide, please. So I'm going to introduce you to something that we're calling the Scale Private Investment Mobilization Project. As Nick and Mira have mentioned, we could summarize the last decade of blended finance largely as follows. There's been lots of transactions, probably somewhere between 1,300 and 2,000 blended finance transactions. The median transaction size has been around 55 million, means by definition, on average, we're not even in conversations with institutional investors. So the benefit we have a rich history of blended finance and private investment mobilization over the last decade that, fortunately, at Convergence, we're very privileged to be able to reflect upon, to really ascertain how can we move forward to mobilize private investment at much, much more significant amounts. Next slide, please. So our colleagues at the OECD do an excellent job every year of trying to ascertain what is the total amount of private investment that is being mobilized by all public sector mobilization activity, clustered around these 6 what they call leveraging mechanisms. As you can see here, essentially we're moving in the right direction, but on average over the last several years, we're only around 50 to 60 billion dollars of private investment being mobilized. That's equal to around 1% of the SDG and climate investment needs in all 142 low and middle income countries. So lots of activity, lots of precedent, but at a high level, really not making a substantial dent into that SDG and climate investment gap that we're trying to do in those 142 countries. Now, one of the reasons is if you look at these 6 leveraging mechanisms and how we're mobilizing private investment, the story has largely been that we are invariably mobilizing for private sector projects and virtually nothing or zero in most years for public sector projects. So for example, IFC is a mobilizer and IBRD generally isn't mobilizing much. And then secondly, in general, the public sector is trying to mobilize without de-risking. And I'll walk you through how that is a little bit of a complication. Probably 20 or 25% of the mobilization is actually happening through reducing risk, and the other 75% or thereabouts is the private sector investing at pari passu or equal terms with the public sector. Next slide, please. The OECD also identifies which organizations are the leading mobilizers, and we've broken them into 3 columns of activities here. The multilateral development banks, the multilateral institutions like the European Union and the Green Climate Fund, and bilaterals. In the case of US, that would be USAID and USDFC as an example. So we can see who's doing the mobilizing. So on the upper left-hand side here, we can see that IFC and MIGA, and then African Development Bank over this period of time have been the largest mobilizers of private investment. But MIGA is the only entity in this whole area whose business is to de-risk and mobilize. In general, all the MDBs and DFIs, most of the bilateral, are trying to mobilize on equal risk terms unless they're in possession of catalytic and concessional capital from their donors, and then they're using some of that to reduce the risk and mobilize. Next slide, please. So the biggest challenge we really have when we're talking to private investors investing in PPPs or non-PPPs in developing countries is Moody's, S&P, and Fitch have rated around 91 of the 142 countries. There's a big distribution of the risk profile, but at the sovereign level, at the government level, the median risk rating of these countries is B-. 76% of these countries are rated B or lower. And when we apply the sovereign ceiling rule, it means that most debt investment opportunities would have an implied risk rating of CCC or single B, in most countries. It means that most of the time, private investors largely say to all of us, listen, I'm sure the project's going to achieve some great impact, but quite frankly, we don't invest at that level of risk. So if we want to be mobilizing at scale, there needs to be much more conscious effort of reducing or changing the underlying risk profile from largely unacceptable CCC and single B towards acceptable for them, and that is double B and triple B. And that is the core of the Scale Private Investment Mobilization Project. How can we use public sector and philanthropic money as strategically and efficiently as possible to create a risk and a risk return profile that will allow an investor to invest? So number one, if we want private investors to be investing, the project needs to be viable. So Matthew is going to be talking a little bit later about creating viable projects. Many investors will look at a viable project in a low and middle income country, see currency risk, see credit risk, see offtake risk, and won't see an investable project. Therefore, what can we do to improve the investability of a project so an investor can invest because it's viable and it's investable, whether that's a project sponsor, whether that's a debt investor or an equity investor. But in general, most of the funding we're trying to mobilize into low and middle income countries, around 81% of the $470 trillion of global financial assets is already invested in developed markets. We're trying to get that funding to flow from developed markets into developing markets. And in general, that money is unlikely going to be investing directly in an individual project in developing countries. They're looking for portfolios. Therefore, how do we create portfolios of investment that are acceptable? So the core of this project is, how do we create investment profile that meets their investment requirements and that will allow them to invest? Next slide, please. So the public sector really has kind of four main choices that they can undertake to really create a risk and risk return profile that will meet the fiduciary and regulatory obligations of investors. The shareholders can transform the MDBs and DFIs largely into de-riskers. MIGA is a de-risker. It's kind of a lone wolf amongst the MDBs and DFIs. There's 480 billion of balance sheet capital on the balance sheet of MDBs and 50 billion of balance sheet capital on the DFIs. Probably around 2% of that capital is exposed to de-risking to mobilize private investment. So it's very, very much a tertiary business. That could change. The second is the 32 OECD Development Assistance Committee members allocate around 225 billion of official development assistance every year. They could take a healthy percentage of that and really use it to de-risk in a wholesale way. We don't see that as acceptable from the developing countries' perspective. They don't want to see that official development assistance used for that purpose. A third choice is you could establish a brand new multilateral development bank or really beef up MIGA to really be a de-risker. That would require a lot of new capital. And if it's a new institution, that'll probably take up to 5 years to get done. We think that the only palatable way to do this in the near term is option 4 here, which is a combination of 2 and 1. How do we use some of that 530 billion of MDB and DFI capital more strategically? And how do we use some official development assistance more strategically to really create that investment profile that will mobilize private investors? Next slide, please. So we in this project, we've consulted very, very broadly over the last year or so, and we'll be releasing in the next week and a half what we're calling a consultations report. And that consultations report says we all collectively agree we're not mobilizing at scale. We all would like to mobilize at scale. What do we think we need to do differently if we want public sector and philanthropic organizations to be mobilizing private investment at scale? We'll release this report. We'll go through a series of consultations in March, April, and May into June, really working with WAPPP and Jody and Zayed and Alexander to figure out exactly what we'll do with your community to really identify by the end of May, beginning of June, before the G7 summit in Canada and before the Financing for Development conference in Sevilla, as to what needs to be done to be mobilizing private investment at scale. Our report will largely identify 4 key components of how this can be done in a scaled way. The first is there needs to be an action plan or strategy. The last decade, there has not been an action plan or strategy for mobilization of blended finance. There's been a series of heterogeneous activity, which has been interesting, but we're nowhere close to mobilizing at scale. The second is we have made blended finance and mobilization effectively way too complicated for all actors. Most donors are saying, wow, blended finance is too complicated. I'd like to get involved, but simply it's too difficult for us to understand. We need to simplify it if we want more funding that is catalytic and concessional flowing. We've looked at all the history of blended finance and mobilization over the last decade, where we've created a framework of how this money has been deployed in different models. We've looked at around the 34 different models, and we're going to propose that we should be standardizing around 12 models to standardize blended finance. The third is, if we do begin to standardize, up until now, each of the providers of catalytic and concessional funding have largely acted independently. That's as a result of that, the average deal size has only been $55 million. We need those organizations to really network together or collaborate together in a network to allocate their concessional and catalytic funding to the best proposals. Up until now, around 75% of concessional and catalytic money is allocated to MDBs and DFIs who do very good things with it, but we're certainly not using that to mobilize private investment. If we're going to be allocating concessional and catalytic money to mobilization, it should go to the best ideas through this network that are aligned with those 12 models. And the fourth is really development finance activities and governance. Move forward to the next slide, please. So big picture, beyond improving the investment climate in countries, which is systemically important in the medium long term, this project really focuses on the hard mixing of funding to create investments that meet fiduciary and regulatory obligations. There's three bubbles here. The first bubble is, how do we basically build up a larger universe of viable projects? In the public sector, we largely call that project preparation facilities, but there's a lack of funding there to build up private projects. And indeed, we think a lack of funding or not enough funding for PPPs. The second bubble here is in column 3. How do we de-risk at a project level to make an investment at a project level acceptable for the project sponsor, debt, and equity provider? And column 5 is, how do we do that at a portfolio level? How do we mix together money in $1 billion fund in a way that will mobilize private investors, and a fund manager then will be injecting it into viable projects? Next slide, please. So when it comes to the standardization, to keep it simple for the donors and give us the degrees of freedom that are required, there's 2 layers of this standardization. The first layer is, let's simplify blended finance and mobilization into these 12 models. Let's agree that we'll allocate concessional and catalytic money through these 12 models to mobilize private investment through these 12 models. It reduces the complexity and simplifies things. And then for some of these models, for around half of these models, there's been enough of a history of the last decade that we can begin to standardize structure and financial terms, indeed, even term sheets for some of those models, where there's other models, there hasn't been enough history there, and we should not standardize within them, just be using some funding within those particular models to mobilize. Next slide, please. And this is just a snapshot of what those 12 models actually look like. The 2 in orange are for public sector projects. All the other ones are for private sector projects. And this is how they all come together really in those 3 areas of project level viability, project level investability, or portfolio investability. Domestic financial sector development's there because the 0 draft of the outcome document is definitely emphasizing the importance of improving domestic financial sector development. And that's why how some of these PIMs are going to be supporting that. Next slide, please. As an example of one of those, a blended finance debt fund, there's been around 150 of these done, 122, sorry, that have already been implemented here. Everyone agrees we should be standardizing one of these models as a blended finance debt fund with multiple tiers of capital. We're going to be proposing it should be standardized with 3 tiers of capital, where the objective is to create an investment grade risk for commercial investors in the senior tier, and that will allow almost all organizations to be able to invest in developing countries because that senior tier is investment grade, consistent with their investment obligations. Next slide, please. As I said later, here's the project timeline. We want to be in a position by the end of May, beginning of June, to have a robust recommendations to put in front of the G7 and the Financing for Development Conference as to if we do want to mobilize it at scale, this is what needs to be done. So we'll be publishing this document in the next week and a half, or releasing it, distributing it. And then we'll be going through consultations to improve the content and the recommendations by the end of May. Next slide, please. And this is the last one. I'll hand it back to our colleagues at WAPP. So we would love to engage with the WAPP community thinking about this project. This project is about standardizing blended finance or private investment mobilization solutions for all the SDGs. We can't have 100 standard models or 50 standard models. We need to collapse down to a manageable number. The donors have told us somewhere between 8 and 12 is probably a manageable number. And we want to be working with WAPP and the PPP community here to really identify what are the best blended finance solutions that would significantly increase the viability of PPP projects and then ultimately financial investment to those PPP projects. So that, Jyoti and Ziad Alexander, I'll pass it back to WAPP.
Thank you, Chris. So we've opened our next poll. That was an invigorating presentation, I have to say. I learned a lot personally, being in this business for so long. And even then, there's so much to learn and so much to, I think data analysis, when you actually see that, makes it so real, so real. And we have so much potential to really leverage every kind of intervention to mobilize capital for the infrastructure needs that we have. So we have opened this next question, which is a really good segue from Chris, Nicholas, and Mira's presentation. And have you worked with blended finance and PPP projects? Even if they're not PPP projects, just let us have a sense so that we can plan the next series of sessions to bring our understanding. So today is just a cursory view of what blended finance and PPPs mean. And then we will, as Chris and Nicholas and Mira presented, we're going to have deeper sessions going forward on one particular topic. So Chris, Mira, and Nicholas, you can see that about 60% said no. I don't know if, Chris, you want to come back? You actually still have time left in your presentation if you want to comment on that.
Yeah, so I think if I've understood that, 60% of the audience on this call have no experience in dealing with PPP.
Yes.
Yeah, I'm sorry, with blended finance and PPPs. Well, that doesn't come as a huge surprise. I think to let a lot of people know that there can be PPP components in a project that a lot of participants in a project might not actually know. So let's say there's an off-taker of services, and the creditworthiness of that off-taker is not acceptable. There's a lot of solutions in the PPP world where there's been a solution to credit enhance the off-taker, as an example, okay? A guarantor of the off-taker risk or anything else to credit enhance that. If that component is there, there's probably a catalytic and concessional funder or funders in the background to actually make that all possible, as an example. I think we're going to be listening to Matthew Jordan Tank from EBRD. Mm-hmm. He's actually getting a lot of funding from donors to do what we talked about in that first instance. We need to build up a larger universe of PPP projects that will be viable. Matthew and his team are doing an excellent job at EBRD in several countries to really do that on a systemic basis. Now, when that happens, that is also catalytic and concessional funding coming into the PPP space to build up a larger universe. And then if that's completely viable without requiring any concessional funding, once it graduates from development into implementation, once again, that is a project that has benefited from blended finance, but not necessarily in the capital structure. So there are a lot of quote unquote blended finance solutions that have been deployed in PPPs, but people may not be aware of it. It's a little bit of an elephant. If someone's just touching the tusk or the ear, they may not be aware that the actual other part was funded through blended finance.
Thank you, Chris. So I see Joan and Ziad have their hands up, so why don't we go to them very quickly? You have
I'll
total of
pass
4
because
minutes.
I was just going to say the same thing, that you might not realize that there was some kind of concessional element in a
Yeah.
transaction you touched. So over to Ziad.
Well, I wanted to thank Chris, Mira, Nick. I mean, this is a fantastic presentation. What it really shows is how many aspects to blended finance there is, how many dimensions. And I think this is what we would like our PPP community to become aware of, that it is not just like one little thing. Blended finance is a world, and it behooves everybody to really do their best to become familiar with it, because there's a lot of benefits that can be derived, especially in developing countries.
Thank you, Ziad. So we still have about 3 minutes, Chris. The question is on AI, digitalization, and technology in general. Do you have any opinion or comments on that?
I don't think I'm knowledgeable enough to really provide much information on AR technology. I see Joan has her hand. Maybe Joan, you might have a better answer than me.
Go ahead.
Yeah, we aren't AI people. I agree with Chris. However, one of the reasons that people price risk incorrectly is because the lack of data, and blended finance is often a patch for that lack of information that causes skewed perception of risk. Anything that AI or data, big data can do to decrease the cost of gathering that information would help price capital better and diminish the need for blended finance. Thanks.
Yeah, on that
Thank you,
particular front, I'd just like to flag for everyone, the MDBs and DFIs have done a great job of creating what's called the Global Emerging Markets Database, the GEMS database, and that aggregates their history of defaults and losses for sovereign and then for private sector. If you actually look at that data, the data suggests that if a risk is single B or triple C, the history of default and losses has been much, much, much better than you'd expect if you were using Moody's, S&P, and Fitch tables, as an example. That's an incredibly important story for us to get out there. Especially, I noticed that I think the majority of people on this call, or the biggest area, was Africa. Unfortunately for us, the median sovereign risk rating in Africa is triple C plus. It means that in general, it's seen as a risky place by investors, but the MDB data suggests the actual losses and defaults of lending into Africa and other countries have been much, much lower than you'd expect if you just used traditional data sets of Moody's, S&P, and Fitch.
All right, thank you, Chris. I think with that, really nicely rounded up the discussion on the structuring approaches and what's to come, really. I mean, that was just a preview, so please do join us in the next, we will have a session every month going forward. And I want to move to our next segment of this session. Aisha and Caroline, if you can pin our next round of speakers, panelists, which is actually Anthony Mongamelli Milwana. He's an economics affairs officer in the Energy Infrastructure Services section at the UN Commission for Africa, UNECA. He focuses on clean energy infrastructure for Africa's industrialization. With extensive experience in the energy sector since 1995, he has worked with leading institutions such as the University of Cape Town's Energy Research Center, the Council for Scientific and Industrial Research. He has also authored numerous publications and was a lead author for the Nobel Peace Prize-winning IPCC team on climate change mitigation in 2007. Next, we have Matthew Jordan Tank, a Director of Sustainable Infrastructure Policy and Project Preparation from EBRD, European Bank for Reconstruction and Development. Matthew is Director of Sustainable Infrastructure Policy and Project Preparation. He covers the energy, transport, and municipal sectors. His work covers upstream policy support, PPP transaction advisory, and project preparation, technical due diligence, and implementation issues. And lastly, we have current senior PPP operations specialist, Abubakar Sambe, a certified PPP expert with 13 plus years experience. He holds a PhD in economics from Aix-Marseille University. He specializes in public finance and infrastructure PPPs, financing, Having worked at AFDB, BOAD, and Quebec's Ministry of Transportation, his work strengthens governance, PPP frameworks, and sustainable infrastructure development across Africa. So you can see it's a very, very rich experience which we bring to the table. And I will try to bring everybody to the front. And what we are really trying to do is bring the experience, a practical experience from each of these stakeholders who are involved in blended finance structures. So first we will go to Monga. Monga, so the question for you is that we see that Africa is the largest receiver of blended finance approaches, and actually their largest audience today is from Africa. So you're really in the hot seat. How can blended finance be integrated into regional policy frameworks to support sustainable development in Africa? So you have about 7 minutes. You're muted.
Thank you, Yoti, and the team in the panel, and everyone who's listening in. First, before I tackle this question, which is a very valid question, considering the status of Africa vis-a-vis sort of financing infrastructure in general. I want to pick up 3 things that will run through my presentation, will be implicit in what I'm come to submit here. One is the fact that complications in our financing models. For instance, PPPs are complex enough. Hence, the success in Africa is varied. It's actually how complex PPPs are. So I was talking offline with Chris yesterday. We're talking about, are we adding another layer of complexity to infrastructure financing? So I think, the question, the presentation that was made by Chris and the team, around, how can we make this financing mechanism less complicated and be simple. It's very, very important, to do that, particularly in an African context. The second one, that I hear that Chris is talking about in the team is around standardization. It's very, very important that we don't have sort of multiple ways of doing things, which may actually complicate things even more. It's actually how are we able, to standardize it so that it becomes predictable, in that sense, and then that capacity, can be actually, be transferred, seamlessly. And then the other one is a strategy. That is what I'm just gonna come about. What is the best strategy, of actually undertaking, this blended finance, particularly within the PPP context. As an African countries, as we stand, we have a huge infrastructure deficit. According to the African Development Bank, we have about, between 68 billion to 108 infrastructure deficit. That's what we have. These are the key infrastructure. I'm not talking about the other side of infrastructure, but I'm talking about the key infrastructure, in an energy, transport, water, and ICT sectors. These are the critical infrastructure. We have them. Traditionally, those kind of projects that we are having, having actually been involved with them like over the more than 10 years within the ECA, is that the public finance or the project finance has been that. And then we know that, over the years, that has dried out. And then also, the fact that we have to post the COVID, we've seen the GDP, GDP debt to GDP ratio becoming, in Africa, which actually has several implications. One is that, for instance, there's a reduced fiscal space within the countries. The crowding out of private sort of investors. So there are so many, other things. So therefore, whilst we need to have sort of to increase infrastructure financing, we need to be wary, of actually, indebting, African countries more. So therefore, the ways of sustainable and innovation in finance is very, very important, and blended finance, should be part, should be part of that. For instance, that, it's, sort of, we have to come up with how to make the African project bankable. How can we invest in them? Because this has been, over the years, the critical issue in Africa, to bring this project to bankability. So therefore, that requires more than the financing. It requires, sort of a host of other things. One of them would be, for instance, sort of the transactional advisory, technical advisory, and what have you. So therefore, we need to look at the blended finance in that context. How does it unlock, or capacitate other things that are needed, for us to sustain, from that. So now, and indeed, one can see that, there are pockets of successes, of blended finance in Africa, particularly in an energy and agriculture space. The solar program of the solar program and many others, are successful. But these are not in a level where we can say that they are, blended finance has been increased. And obviously, in some projects where blended finance is part of it, people are not aware that the blended finance is part of certain projects. So therefore, we need sort of other ways of how we actually do that. From the ECA point of view, if I may conclude, I would just point up to a few sort of takeaways in terms of our experience. The first one, is that we need to identify the strategic entry points, within the blended finance. What are the strategic entry points, especially within sort of the African region? For instance, we do have regional infrastructure master plans. We do have sort of development plans, regional energy policy and stuff like that. So we are working at the region. So therefore, where can we identify sort of the strategic entry point, particularly from the regional perspective? Currently we are also a part of the implementation of the program for infrastructure development in Africa, which is actually a regional framework, a regional flagship approach. So therefore, how do we include sort of blended finance within that? Secondly, that our experience is around the enabling policy environment. How do we actually create an innovative environment that will ensure that blended finance, is part of that, and also a conspicuous part of that. Our experience also has actually shown that, institutions, we also work within the PPP space. The institutions are very, very important in driving this, so how do we actually enhance the institutional capacity? For instance, how do we move forward to ensure that we have this institution and then we institutionalize this, within the countries? There are others that are around transparency and accountability, and how do we ensure that the blended finance are able, because private sector is still very, very important. How do we ensure that? And then,
Monga, you have 20 seconds left.
This is the last point. We need to have a dynamic collaboration between public, private sector, and philanthropic actors. We need a forum, for that, so that we can be able to showcase that, perhaps, that's where the organizations such as WAPPP are coming in. How do we ensure that we have all of this? So in short, I come back to where I start. How do we simplify this? To make sure that, we don't add any other layer of complexity. I submit.
Thank you, Monga. You've made such excellent points, and so deeper points, which I think we need to all delve together in our future sessions. And I hope you will come back and join us. So next, I will go to Matthew with the same question, Matthew. Based on your experience, how can MDBs leverage blended finance to de-risk these kind of projects and attract private investors? And you have 7 minutes.
Okay, great. Well, firstly, let me thank both WAPPP and Convergence for the invitation to be part of today's session, but also throughout the year. I understand there'll be several sessions, and we're very happy to participate. Other colleagues from EBRD, I'm sure, can add to the discussion. But for today, I'm going to give you a bit of an overview. Please stop me if I overrun. I'll try to keep to the time. Just how we approach attracting in private sector investment into infrastructure. And that is one of the key goals, really, of an EBRD. And I think, in my view, it should be one of the main goals of the MDBs as a system. EBRD is, as for those who don't know, we are a primarily private sector orientated IFI. 75% of our financing goes to the private sector. One of the main goals in the infrastructure area is indeed mobilization, which has been, Chris spoke very in great detail and excellent data to support how important that is. I think it's one of the main litmus tests for MDBs today. How well do we do at mobilization? EBRD in 2018, here's just a statistic, we mobilized direct mobilization of 1 billion euros in 2018. Last year, we did over 4 billion. So it is an institutional goal, which we're achieving, but there's much, much more to do. Now, one of the main activities of my team is indeed PPP advisory, which was alluded to before. What we do here is really to try to essentially partner with our country clients who don't necessarily have as much experience in PPPs, and that's not their fault. It's just they just haven't been able to accumulate a critical mass of experience. So we come in with our experts and our knowledge from other markets and help them to build up viable pipelines of PPPs. And so we've done things like dry ports in Egypt, maritime ports in Ukraine, Sofia Airport in Bulgaria. We're working on now national project preparation facilities in Uzbekistan, in Egypt, in Greece. And the whole point of, I think on this, before I go into a few examples of how we've attracted in private sector, I think the whole point of all this effort is to try to find ways to, on the one hand, increase capacity on the ground. It's not just learning by doing, but actually, using our ability to earn fees from this transaction advisory and plow those fees back into creating and hiring experts from the countries on the ground, working hand in glove with our client countries and their PPP units, et cetera. So that's the idea of the National Project Preparation Facilities. And we're focusing on things that also can be scalable. For example, in Egypt, desalination PPPs, schools, hospitals, indeed the dry ports. These are all things that you can kind of replicate the structures. I think this is a very, very interesting moment to be talking about blended finance and PPPs. Why? Because simply stated, many, many more countries face very serious fiscal constraints. Part of that was simply, loading up on debt, public sector debt, and they're squeezed. But COVID certainly added to that. That was an extreme effort to sort of deal with the pandemic. But the result is that many countries just don't have the fiscal space to do things with the public sector. And so they are turning, and I see this across the board. I've been at EBRD for 17 years now. It's a great place to work, and that's why I'm still very, very busy with it. But I'll tell you, I've never seen as many countries coming now for support on both preparation of PPPs, but also financing of PPPs. And so I think this is both an opportunity, obviously, for MDBs to be involved and other private sector investors to see opportunities, but it's also a challenge because if the public sector doesn't have budgets available to support PPPs, and that is a critical element here, it's going to be very hard to do. It's going to be harder, all things considered, to do certain types of PPPs, certainly. And I just want to make that point, which things like social infrastructure, public transport, wastewater treatment, particularly in lower income countries, all of this is very difficult because they don't produce those types of PPPs direct user revenues, direct user charges, tariffs, and so on. So they are social infrastructure, or they have a very strong social kind of component to them. And so it's very, very hard. So you are seeing, and we are seeing, a focus on things that can have cost recovery level tariffs, desalination to the industrial sector, ports that's dollarized and done with shippers and so on, and customers who are willing to pay the full cost of the projects, and so on. So it's just a point I wanted to make. It's a challenge, but an opportunity, but also a challenge. Now, blended finance. Let me give you a few thoughts. Firstly, I completely agree with Chris. Simplicity is a virtue. Things have become overly complex. People are ambitious, just they engage their minds into this, and people have come up with very, very sophisticated products, and probably too cutting edge, particularly for emerging markets and developing economies, places that don't yet have full capital market development. Some of the things are untested, frankly, and not only will investors struggle to use these types of things, but so donors behind which they backstop a lot of this blended finance, they are going to struggle to understand how to approach these types of things. So I think we have to make things simple and straightforward. Blended finance, second point, it's not the right thing for all projects. Some projects simply do need grants. Wastewater treatment in very low income countries, that needs, you can't, you're not going to work your way out with a fancy guarantee, behind the, you need to probably just, do a CapEx kind of subsidy, buy down, from the grant side to make some of those things viable. But let me give you now, in the time, a couple of minutes I have left, a couple of examples where we've done, I think, we're proud of some projects that we've done where we've tried to create more space for institutional investors to enter into PPPs. And the first example is a product that we came up with, which we would love to see used by everyone around the world. I think there's great potential still, and we're doing it wherever we can, which is it's a standby liquidity product. And what it does is, if an investor wants to be able to attract institutional investors, they have to have a project that is investment grade. It's rated as an investment grade project. If you're doing that project in a country that has a sovereign rating that's below investment grade, you face a real challenge, which is typically projects cannot pierce the sovereign rating ceiling. And so what we've done here in these cases in Turkey and in Egypt, the first one was in hospitals, the second one was in renewables for solar projects. We provided EBRD provided a standby liquidity facility, which was made available to the investor, who then, when they went out to issue a bond for the financing of the project, that was looked at by the rating agencies with a standby facility that would come in very quickly, be able to be used and drawn very quickly, much, much faster than the typical 2 to 3 years
20 seconds.
in the event of an international arbitration case. And we've been able to effectively see the rating agencies increase the the project rating up to and above the sovereign rating, and that meant it was investment grade. So we did that with Scatec, the Norwegian investor in Egypt, and we did that with Meridium and Renaissance in Turkey. So I think the last thing for yep, I'll just finish right here.
Seconds,
yeah, I just wanted to say another thing that I think would be great for future is we are developing a climate syndication program product, which is essentially for blended mobilization with first loss cover for B lenders. And we have high ambitions for this. I think it'd be an interesting topic for the future, but fully behind the effort and really look forward to staying engaged in this throughout the year. Thank you very much.
Thank you, Matthew. I'm trying to find Ababakar. Is he still with us? Oh, yes. Ababakar. So same question, but I think a little bit, you saw in Chris's slide that Africa Development Bank is actually the top 3 mobilizer of private capital. So what is Africa Development doing differently than what other multilateral development banks haven't been able to do? So go ahead, you have 7 minutes. You're on mute.
Sorry, I said thank you everyone for attending this event today. I will share first of all experience that we have at the African Development Bank on leveraging on blended finance to the benefit of the PPPs. I will also, based on an experience, try to share some case that we did very well at the African Development Bank, and try to call on partners, donors to more fund to gather more resources for the different activities. So when it comes to the PPP project, they are very risky project, most of them, and then to de-risk the PPP project and attract more private investment toward the blended finance at the African Development Bank, we assist regional member countries through 2 different ways. So we can do it whether it's upstream transaction, or we can do it during the downstream transaction. So that's how we do it in the African Development Bank. So when it comes to the upstream activities or transaction, we all know that the perception, as the presenters was saying, the risk perception in Africa is very high, and compared to other regions in many countries, in other regions in the world. And then on top of that, we have member countries, they have project ideas. And when it comes to the project, they are not very mature. And we all know that it can be a key obstacle when it comes to attracting a private investor. So what we do at the African Development Bank to overcome such a situation is that we provided concessional loan and grants to our different operations we have. So we have the institutional support project. We can do it throughout the program-based operation, as well as technical assistance and transaction advisory. So most of the time we have a project preparation facilities, a lot of them. We can talk about the NEPAD IPPF, which is a very efficient project preparation facility when it comes to cross-border project. So we most of the time can grant a country up to 3 or 4 million for the preparation of the project. And then when it comes to, we also have the UNDF for the urban project. We have also the African Development Fund project preparation facility. For the small project, most of the time is in agriculture areas, and then the grant we provided could go to range from 200,000 unit of account till 1 million unit of account. For the complex project, we can provide more grants up to 5 million for the structuring, the preparation of the project. And what we noticed that, when we working on a project, at the end of the project, whether it lasts for 3 years or 5 years, the project, we go and assess afterwards if the project met his objective. And most of the time for those projects, what we aim is to have more private investment compared to the GDP of the country. And then we've noticed that in the country, the different countries we are intervene, we notice there is an increase of private investment. So that's a call on different partners to invest more in the preparation of project, because this is one of the obstacles when it comes to tap on a private investment throughout a PPPs. And the other thing is that the risk perception, private sector, most of the time, they want to come to Africa, invest, but they are a bit reluctant when it comes to our, the PPP environment. So through our different instruments, whether it's institutional support project, whether it's a program-based operation, we assist different member countries in improving the PPP environment. So we did it in Senegal, assisting them to improve their PPP law. And then, Senegal is one of the most one of the best countries when it comes to attracting private investment in Western region. We did it in Kenya. We did it in the Maghreb when it comes to other countries like in Tunisia. We did it, and now we are currently working on countries like in the Gambia, in Madagascar, because when it comes to small scale PPPs, private sector they want to intervene, but there's a lot of inconsistency throughout in the regulatory framework or the legal framework. So assisting those countries upfront to improve the PPP environment would help attract more private investment. So that's something that we're doing in the upstream transaction. We also intervene in the downstream transaction because many projects they might be very interesting, but they fail to attract private investment because of the perceived risk, such as the default risk by the contracting authority when it comes to the PPPs. It can be lack of financial return or the social acceptability due to high cost in many projects. So to assist the member countries in that regard, what we do at the African Development Bank is that we provided a lot of concessional loans. It can be guarantees. Just to give you a number of how the assistance we provided to the countries. Back to 2017, we assessed our different PPP transactions. And then we provided up to 41 downstream transactions, and that those transactions, they also benefited from the guarantees. So just a quick view of the different instruments we have when it comes to the downstream transaction. We can talk about the different guarantees we have. We have the partial credit guarantees that help enhance credit worthiness by covering debt services obligation, enabling the better financing terms. We also can name the partial risk guarantees to cover political risk. And for that instrument, we've used it quite well in a project we had in Kenya. That was a wind power project in Kenya. And then the wind power project would be producing some electricity, but we need to connect that wind power project, that wind power to the station, and then they didn't have the transmission line. And then the private sector were very reluctant in investing in that project because they didn't know how long they're gonna take to build that transmission line. So what the government of Kenya did is that they asked for the partial risk guarantee. So what we provided them with a 20 million funding to cover that risk. So we cover depending on the different scenario, but it's from 3 to 5 month delay that the African Development Bank provided this guarantees. So that's something that we did in that project. That was the Lake Turkana power project. That's what we did in Kenya. And also for that same project, there was another issue which was related to the road. The quality of the road is very bad in terms of transporting the wind turbines. So we provided through a partnership we have with the Netherlands government a 10 million grant to improve the quality of the road and then to make public sector more interested in that project. So that's something we do, and we're doing it quite well.
20 seconds left.
Sorry, and also we have the viability gap funding, which we provided with the in Senegal with the Dakar Diamniadio toll highway, and then to downgrade the upfront cost of the project. So basically, that's the different instrument that African Development Bank used. And then I was quite brief, but thank you for your attention. And then we stay available if you have any additional question. Thank you.
Thank you, Abubakar. Yes, definitely. This is just a preview of what's to come in the rest of the sessions. We're going to go into detail, and I hope you will come back and join us. Definitely a lot to unpack in some of the examples which you said. And it's also very clear from all three presentations that it takes a village. It's not just a project which gets funded, but really what comes before, what comes around it, and what comes after is extremely important. So thank you so much, Abubakar. And you can see from the chat, lots of interest in what you are doing and what Matthew you are doing, and Monga, excellent points. And I will ask for your notes actually, so we can bring it. So I will actually move to Joan now to say anything which you want to add to some of the questions in the chat, and maybe your closing remarks, and then I will move to Ziad to close. Thank you so much.
Thank you. I won't try to tackle the questions in the few remaining minutes. However, we are all available for follow-up. I just want to thank everybody for this great conversation, especially the panelists from UNECA and EBRD and African Development Bank. Great real-world examples of work on the ground. This is a discussion that's only the beginning of a year-long program that Convergence is co-hosting with WAPPP. So in the next few sessions, we're going to dive into blended finance at a deeper level. For example, we'll be exploring the potential of standardized approaches at structuring blended finance to attract private capital at scale. We're here to engage with you and love to hear your thoughts. So we're excited to see everybody dial back into the upcoming sessions. And thank you so much to WAPPP for hosting. Over to you, Ziad.
Thank you very much, Joan, and thank you for bringing Convergence to partner with us for this important series of discussions. As I said in my opening remarks, I think we are not doing enough to bring private sector financing into achieving the SDGs. And this is what we're trying to do. Blended finance is an important tool in that regard. It's more than a tool. It's as we will be seeing during the various sessions this year, it is multiple tools in one, and a great way to for everyone to benefit from it and deploy it, especially at the small scale PPP level. I add my thanks to those of Joan, to Matthew, Bonga, Bakar. Fantastic presentations, a lot to learn from you guys. Looking forward to having you in future sessions. Also, of course, Chris, Mira, and Nick, really fantastic. Jyoti, you and the WAPPP team, thank you very much for putting this together, and looking forward to the next session.
Thank you, everyone. See you in March.
Thank you. Bye-bye.
Thank you.